When you say risk management, what is the first thing you think of? It is life insurance, isn't it? The first thing to take care of when it comes to risk management is the life insurance. But the question every one of us must ask is that, is your life insurance policy hurting your investment portfolio? You may wonder, is that even a concern? Yes, it is a concern. Life insurance. What comes to your mind? Do you think of an insurance plan that promises sum assured along with a lump sum at maturity? You may have a couple of them in your portfolio. One solution to all your financial problems and a secured life. The unofficial tagline for every investment insurance plan out there in the market. Especially the ULIPs, a mutated form of investment insurance. It is claimed to be the ready-made financial plan for all. But just because a product is termed safe and a majority is buying it, it does not mean it is safe. I have added links to review articles of famous ULIPs at present in the description below. These articles prove why ULIPs are a bad investment product. A slow poison that is investment insurance. Over the years, insurance companies, their agents, their advertisers have romanticized investment insurance plans. They have presented insurance plans with tax benefits and their supposed investment benefits. They leverage the words like assured, guaranteed, and their excellent marketing skills developed over years to sell a product. They claim it to be the jack of all trades. But in reality, they lock up your savings for a meager life cover with no respectable appreciation for your investment. Investment insurance policies deceive investors on three different fronts. They are insurance, investments, and tax benefit. We will tackle the investment part first, followed by the insurance part, and finally the tax benefits. All facts on the table, then we will decide whether it is a fair product, whether it deserves to be in your portfolio. Assessment of investment aspect. In this section, we will compare the return and risk aspects of different investment products with the investment insurance products. The table on your screen shows the average annual return and risk levels of different investment instruments, alongside endowment insurance plans and ULIPs, that is, the investment insurances. Endowment insurance plans offer an annualized return at a rate of 5 to 6% at best. Even fixed deposits offer a higher return than a best endowment insurance plan. Of course, TDS is applicable on fixed deposit returns. But the post office time deposit and PPF offer even higher return, at least 7% per annum for the same risk levels, possibly even lower risk since their return is assured by the Government of India. Among these, an outstanding investment instrument is the liquid fund. It is a debt mutual fund. In the long term, the return rate of liquid funds are on par with the PPF at a rate of 7% per annum or even higher. Liquid funds are outstanding because they offer, as the name suggests, liquidity. It is an advantage none of the above investment instruments have. Liquid mutual funds have no lock-in period, which makes it an ideal investment instrument for investors who have low investment risk appetite. On the other hand, we have ELSS mutual funds versus ULIPs, equity-oriented, high-risk investments. ELSS mutual funds give better returns, at least 5% higher return than ULIPs. Moreover, ELSS mutual funds offer superior liquidity with a lock-in period of just 3 years compared to 10 years of lock-in period with ULIPs. It is very evident that the investment insurance plans are the poorest choice when it comes to investment. There is no question about that. But do their investment aspect make it worthy enough to consider them to have in your portfolio? Let's find out. Assessment of insurance aspect. Let's do this with an example. Let's assume a person having 1 lakh rupees per annum as investable surplus. With this money, he wants to have his life covered and wants to invest for his financial goals. He has a total of 20 years time period. Let us see all the different options available to him. Option 1 is buying an endowment plan. Option 2 is buying an ULIP. Option 3 is a combination of term plan plus PPF investment. And finally, option 4, a combination of term plan plus mutual fund investment. Let us compare all these 4 options and then decide what is best for him. If you choose option 1 to buy an endowment plan, You will have his life covered for 20 years by investing 1 lakh rupees per annum for 10 years for a life cover of rupees 12 lakhs, and by the end of 20th year, you will receive a maturity value of rupees 22 lakhs. This return is at an average rate of 6% per annum and the risk level is very low. And then we have option 2, buying an ULIP plan. The policy term is 20 years for 1 lakh rupees premium for 10 years, which gives a life cover of rupees 25 lakhs. On the end of 20th year, you will receive a maturity value of rupees 36 lakhs. It is at an average return rate of 8% per annum. But unlike an endowment plan, the risk level with unit-linked insurance plan is high. For option 3, we have a combination of term plan plus PPF. With the term plan, you will have your life covered, and with PPF, you will have your investments covered. A term plan for 20 years, paying a premium of 12,250 per annum will give you a life cover of rupees 25 lakhs. And by investing the remaining 87,750 for 10 years in PPF, you will receive a maturity value of rupees 29.6 lakhs by the end of 20th year. It is at an average return rate of 8% per annum. The risk you take with PPF is very low. Finally, we have the star combination for option 4, that is term plan plus mutual fund investment. As seen already, term plan gives you a life cover of rupees 25 lakhs for 20 years. By investing the remaining money in mutual funds, at the end of 20th year, you will receive rupees 67 lakhs. It is at a return rate of 12% per annum and the risk considered is high. Out of all the options considered, the combination of term plan plus PPF is the best option for low risk investors. And for high risk investors, the combination of term plan plus mutual fund is the best option to go. But there is one more factor we must consider before making the final decision. That is the taxation of returns. Assessment of tax benefits. Investment in certain instruments are exempt under Section 80C for up to 1.5 lakh rupees per annum. They are endowment insurance plan, unit-linked insurance plan, term insurance plan, PPF and ELSS mutual fund. So all the options considered are exempt under Section 80C, but it is only for the investment. What about the returns? Are they exempted too? Let's find out. Taxation on benefits or returns. Option 1, endowment insurance plan is completely exempt. The return from unit-linked insurance plan is completely exempt. Term insurance plan is completely exempt too. And then there is PPF. The PPF returns of option 3 is also completely exempt. And finally we have ELSS mutual fund. It is taxed at 10% under long-term capital gains tax. So how does LTCG work? Does it make ELSS mutual fund less attractive and less efficient? Let's find out by understanding LTCG at 10%. From the example we have seen in the previous section, ELSS mutual fund return was rupees 67 lakhs, of which the long-term capital gain was 57 lakh rupees. At 10%, the tax payable is rupees 5.6 lakhs since the taxable return is only rupees 56 lakhs because 1 lakh rupees is exempted from LTCG, so the taxable return comes down to rupees 56 lakhs. So what do you think will be the post-tax return? Post LTCG, the investor will have rupees 61.4 lakh rupees in his hand. Even with LTCG tax and considering average returns, ELSS mutual fund gives you the best return. Investment insurances are for sure jack of all trades, but they are a master of none. We have very solid evidence that for risk-averse investors, the combination of term insurance plan plus PPF investment is the best option to go. And for risk-tolerant investors, term insurance plan plus ELSS mutual fund investment is the best option to go. Which one of these is your option? That is for you to decide. If you like this video, like and share this video with your friends. And of course, don't forget to subscribe to Holistic Investment Planners.